Listener questions. I love doing listener questions. Miranda from New Jersey. I've been hearing a lot about opportunity zones lately, and I'm kind of confused. Can you explain what they are and whether or not you think it's something investors should be taking advantage of?
Yep. Well, in the last segment, we talked about that, and the answer is it's confusing a lot of people, and I don't think you should be taking advantage of it yet. I think what's going to happen, I alluded to it last time, I think if you're taking a neighborhood where people live and you want that neighborhood to get investments, all right? So you take some of the retail stores that aren't operating anymore, maybe boarded up, you fix those up. You take some of the residential neighborhoods, apartment buildings, but also single family homes. Most of America neighborhoods are single family homes. So if the objective is to incentivize people with money using tax policy to put that money into what might not be their prime target of where to put the money, but now because of the tax incentive you're doing that to benefit the neighborhood. And a lot of the neighborhoods are residential. So the fact that what they've done here is created something that largely disqualified, like an example, okay? I sell a business. I have $1 million. I could go buy 10 houses in a neighborhood and then improve those houses. But if the rule says I have to spend another $1 million improving the houses, well, then I'm not going to do it. And that winds up backfiring for another reason, by the way. If I had to double the investments, I spend $100,000 to buy a house, I put $100,000 into it, I'm not going to be able to rent it to the person who currently lives there, right? A lot of these houses are already rental, so if they're paying $800 a month, and I go put an extra $100,000 into the house, I'm going to need to jack the rent up, and so that actually backfires on the people that live in the neighborhood. So I believe that there are smart people who are pointing this out to the powers that be, and they're going to unravel that piece, and then Miranda in New Jersey, get ready to pile your money into opportunity zones. So if you have assets that you are selling that are creating capital gains for you, I think it's going to work out in our favor. And stay tuned here, because when it does, we'll be the first to let you know. And we're creating a filter on Own America's marketplace that's now called Renters Warehouse Marketplace. We're building a filter that will allow you to search real estate markets and turn on the opportunity zone filter, so you can actually see what real estate is for sale inside of an opportunity zone. So if it happens, it's going to be wicked cool.
You talk about smart searching. That's the way to do it. I like it.
doubt.
Next question, Andy from Minnesota. My wife and I have been investing for a couple of years. We have several rental properties and have funded them so far with our own cash. We want to keep acquiring properties. Should we seek out private money? Or should we wait for our cash to build up again so we can fund the next property ourselves? This will take time, however, and require a bank loan, so it limits our options for properties we can buy. What do you recommend, Greg?
If they're talking about long-term investing, which it clearly is what they're talking about, private money is going to add a short-term clock on your long-term strategy, so I would avoid it. Right? Private money, also known as hard money, those tend to be people that are loaning money out at higher rates with shorter terms. And so those can work really well for somebody who's flipping, which I don't talk much about, right? So I find a house I want to buy and fix up and flip. So I borrow short-term money, 1 year money, 18-month money, right? Which is expensive, and I have to pay it off in 1 year or 18 months. That's plenty of time to buy the house, fix it up, and then turn it back over again. That can work fine. Total mismatch for a long-term accumulation play. But what you can do, so yes, keep building up your cash, okay, Andy. Number two, go and talk about getting the bank loans. If you've bought the properties that you own so far for cash, you may be able to refinance those properties, pull some of the money out, buy the next one with cash, refinance that one, pull the money out, add it to your stockpile of new cash, buy the next one. I would be really comfortable, if I were you, thinking about this, and whatever your longest term threshold is. Is it 10 years? That's short. Is it 20, 25, 30 years? That's just right. When you start thinking in those terms, start with where you want to end up. How many houses do you want to own at the end of your investing career? How many do you have now? That means how often, you can figure out very quickly how often you have to buy another property to keep up your pace. And if you're able to do it, if you're able to meet your goals with your own cash and then very responsible financing, like putting down 30, 40, 50% down payments, or buying for cash and pulling out 50 or 60%, so you're still sitting with 40% equity in the property, that's the way that no matter what happens in the economy, no matter what happens in your world, You've got cash flow coming in. You can wait any kind of market conditions out, good or bad. And it's all about never having to give a property up because you were risky with the way you financed it.
So that was my next question. Why do people, when they start investing in single-family rentals, why do they have to give the property up?
Well, if they buy with private money and they have to refinance that, so you borrow the $100,000 from a hard money lender or a private lender, it's an 18-month loan. You got to pay it off in 18 months. What's the plan, right? Are you going to refinance it in 18 months and then pay that lender off? Or why don't you just finance it with the other lender to start with, the one who's going to give you the longer term money? So it's like investing in your 401k, but using a margin account with your stockbroker to do it. It's a get rich quick type financing. It's a buy and flip financing applied to a long-term buy and hold strategy. It's a total misfit. So what happens is you wind up at the mercy of a lender. If you can't pay them off, you have to give them the keys.
Pretty much. I mean, unless you're going to go to a community bank and work out some deal with them, but that generally doesn't happen with community banks. So at the end of the day, for me, taking a long-term perspective on real estate always 100% makes a lot more sense than taking a day trading mindset. You never really win when you day trade, unless you are high-frequency trading and you have the shortest lines going into New York. Outside of that, you're not going to win.
Show me anybody who ever won a marathon by taking off at full tilt off the starting line.
Right, yeah, it doesn't happen.
Right.
Yeah, absolutely doesn't happen. The best investors always take a long-term strategy. It's what Warren Buffett is a huge proponent of, and many other great investors, especially in the real estate space, also agree with us.